And good morning, everybody. Thank you for joining us today for this interesting discussion, or promisingly interesting discussion. We will do our best to make it interesting discussion. And we will cover the equity markets, the volatility of it, and what an investor can do with it. So there's lots of interesting questions there. Okay. Let's see, so it's 10:02. I think it is okay to begin. So why don't we start? And then I'll just go through the companies alphabetically, so by company name, and give everybody a chance to introduce themselves. So Joe or Marc, who wants to introduce Brandywine?
Mike Dever.
Okay, please go ahead.
Yeah, Brandywine was founded 40 years ago after some discretionary trading I did myself, and continued through the 1980s. And we created systematic processes in the late 1980s that we managed money with during the 1990s into the 2000s. We also got involved with some early stage venture businesses that we founded and ran through the 2000s, and really got back to the full-time trading with market neutral equity strategies and managed futures, and now a protected equity product in the 2010s and into the 2020s.
Thank you so much. So Jerry with Chesapeake.
Hi, I'm Jerry Parker, Chesapeake Capital. I started Chesapeake in 1988. And from day one, it's pretty much been trend following, momentum style, different types of momentum, maybe different entries and exits. We sort of obsessed with diversification and trading as many markets as possible. We were one of the first CTAs probably to trade single stocks, and many different ways, made some mistakes along the way trying to put single stocks in the portfolio and how to do it, and trading too many and then not trading enough. But now we trade all the futures markets around the world, and cash equities, some cash equities in our fund. We have a couple funds. One is a private fund, and one is a CTA, trend following, managed futures mutual fund, EQCHX.
Excellent. And Nikolas, please go ahead with Strategic Capital Advisors.
Good morning, everyone. Thanks very much. Strategic Capital Advisors is an arm of the Strategic Group, which is a private equity firm out of Puerto Rico. About 18 months ago or so, we purchased Paskowitz Asset Management. And basically that became one of the lines of business in our asset management business. So we have CTA products, we have crypto products, standalone funds. We have some dedicated power and energy products that we're working on as well.
Okay.
So the specific products we're going to be addressing today, coming from the Strategic Capital Advisors arm, have to do with our Contrarian 500 program, which basically mixes mean reversion and long volatility trading strategies in the S&P sort of large cap equity world, using what we call a swarm intelligence technique. So we'll talk a little bit about that later, and basically how we tend to deal with market volatility.
Excellent. So Robert, go ahead.
Thank you. I'm Robert Zuccaro, founder of Target QR Strategies and manager of Golden Eagle Growth Fund. My investment style as a money manager dating back to 1977 can be categorized as quantitative management, aggressive growth, or momentum. Until recently, my funds were characterized by very high portfolio turnover. About a year ago, Elizabeth Warren, senator from Massachusetts, floated a proposal to tax all securities trades at a rate of 0.5%, which would effectively put our 2 equity hedge funds out of business. I had to come up with a solution for a low turnover portfolio, and we did. It's called Golden Eagle Growth Fund, which invests in the world's fastest growing companies. By way of background, I started in the investment business at Brandywine in 1967 and was at Axe Houghton, managing the Axe Houghton Fund starting in 1978, beating the market for 6 straight years. And along the way, I've accumulated more than 3 decades of successful money management experience. I am an early practitioner and creator of quantitative management, positive earnings surprise methodology, and new high stock disciplines, which are being used in our fund.
Well, thank you so much, gentlemen. That was a very nice introduction. And Robert, since you are already kind of talking, why don't we jump to the review of current markets, and how do you put it into your perspective? What has changed? Is it that much different, or is it just the typical cliche that things are never the same as they used to be? So how do you see it from your perspective?
I would characterize it as never the same. I started in the business in 1967. Back in those days, we didn't have computers. The only investment tools we had were annual reports, quarterly reports, and the S&P stock guide.
Okay.
This used to be the Bible of the investing business. If you open it up, you will see a lot of data for each company spread across the 2 pages. Back in those days, I used to look for rural stocks, always being a growth stock style manager. And the most important columns to me in the stock guide were the annual earnings, which were reported and published for 4 years. The base year is at the bottom of the ruler. I used to build bar charts, and every one of the ensuing bar charts had to be above the ruler. So in addition to buying fast growing companies, I was buying consistent earnings growth. Now, when I came into the business, there was no NASDAQ. The NASDAQ was introduced in 1971, when they installed large scale computers the size of refrigerators to track the quotes of all market makers at the same time. Before the NASDAQ, brokers were required to make calls to 3 different brokers in order to get the best price for his client. When the NASDAQ was introduced, it also introduced its first index. And in that index, among the 10 largest stocks was not a single technology stock. If you look at S&P 500 companies today, you will find that the largest 6 stocks by capitalization are large cap stocks, which did not exist 40 years earlier. Now, we are going through a very unique cycle in stock market history. We've always had expansions before, followed by recessions, and generally expansions were ended by a mountain of debt, which caused the economy to contract. This time around, starting with the COVID-19, we have an exogenous event that has affected the stock market. And what this event is going to do is create the biggest dichotomy in the stock market in many years, where the technology companies move forward and the rest of the broad-based market indices, which include the spiders, the MDYs, the RJRs, do not, because they hold face-to-face competing companies such as airlines, restaurants, hotel companies, and also cruise ship companies. Now, this is a draconian environment for some companies. As an example of that, American Airlines, a service company, reported that its revenues for the second quarter will be 90% below what they were in the first quarter. The journal yesterday talked about the divergence in performance between the NASDAQ and the S&P 500, which is the widest in many years. This is not something unusual, but this is a structural change caused by the epidemic that will continue for many years. So the market is no longer the same. And 40 years from now, if we were to get together again, it'll be entirely different than what it is today.
Very interesting insight. I remember from when I started as an equity analyst in Chicago, and actually stayed in Chicago ever since. I worked with value line databases to merge them with some others. So I still remember those sprints, still remember those books. So that's quite an interesting. And talking about the markets and how things changed, here is just a rolling volatility of the markets. Let me just move my Zoom panel a little bit to the side. You can see this is just from the beginning of last year. So it's a monthly 30-day rolling volatility of S&P 500 total return. And you can see that it's enormous jump from the levels that we've seen before. And actually we can make the scale larger, but it will be almost the same picture for a few years back. So that's how huge the volatility spike was, and obviously there's additional measures. So anybody wants to comment on what was kind of an expected move once people started talking about the pandemic and potential shutdowns, and obviously there were disturbing news from China about closing down cities, entire cities with many millions of people. Was anybody able to see where this is going to and be correct about that? So any comment? Anybody wants to pick that up?
I think one again, I'm not sure how much insight there is in this, but one thing that I had been following the lead up to that was the degree to which copper has sort of been leading that market on the way down. So a lot of the move that played out in the equity markets and even up to today over the last sort of 3 months has been sort of telegraphed in the price of copper. So that sort of presaged a lot of the down move and the bounce as well. And again, people would argue that that might have something to do with, the use of the industrial metals coming out of China.
No, that's very interesting. Yeah, so finding a leading indicator, and I'm pretty sure that whatever happened caught many people by surprise. So anybody wants to comment on what was the most unexpected kind of market move? Even though everything was unique and unprecedented, so everything was unexpected, but at the same time, does anything stick out in particular?
Well, I think there was a couple of markets that had some crazy moves, and gold, we were long gold, and then it crashed and it rallied, and long 10 years, and they crash and they rally, and then I don't even know what happened in the Aussie 10 years. That was the craziest chart I've ever seen with that crash and then rally. And then the euro and the yen, kind of the similar stuff. So it was just a lot of panic and chaos, and, looking at the breakouts and the trends and the moving averages is what we do. So there was a lot of potential there. And we don't really usually care too much or think too much about why is this happening, but some unprecedented kind of moves just looking at the charts, and it was really difficult to sidestep those. I know I tried to follow my system. I tried to exercise some sort of money management risk control by reducing positions. And then on some of the trades, it was so volatile at the initial trend change, or at the going from long to short, that I just sort of said, this is crazy. I'm going to sort of sidestep some of these and not take some of these trades, which is sort of a big no-no. But I think a little bit of discretion, this was probably the one period where I didn't feel too bad about reducing my positions just to see what was going to happen and wait for things to settle down a little.
Thank you.
Can I comment?
Of course, go ahead. That's what we here for.
Volatility has created the quickest bear market in history, one in which the S&P dropped 33% in a short span of 5 weeks. That's never happened before. Now, the market is up more than 35% off of its lows, and I have yet to hear or see the words new bull market in print. In fact, there are people out there saying that this is a bear market trap. Well, if you look at the 13 bear markets since World War II, the market has never advanced 40% and then gone south, establishing new lows before. Like it or not, I think this is the statistics are telling us that this is a bull market. And what a lot of observers don't understand is that the stock market is one of 10 leading indicators compiled by the conference board, and it's always looking ahead 6 to 12 months. Despite the bleak headlines we read day in, day out, the market is ignoring that and looking ahead to better times.
So what would you think, because there's also a lot of counter arguments saying that in particular, this bull market is led by the liquidity that is put in by the Fed and massive purchases.
As a money manager, we always 100% invest in the market. In the case of our fund, it's 120% because for us, volatility is an asset. Our portfolio has done very, very well this year. Because the earnings of the underlying companies are growing very dramatically. Our companies grew their earnings 56% in the first quarter, which means that they're less resistant to the economic cycle, and corporate profits dropped 5%. Despite all the carnage in the market, there are actually stocks that have more than doubled in 2020.
Interesting. Well, excellent. So with Brandywine, what guys do you think about this level of volatility as we've seen? Is it going to be here? There's lots of talks about second wave, third wave, whatever else coming next. Massive bankruptcies, again, liquidity injections. They seem to be pulling in different directions, but they are all extraordinary forces, and they can all add to massive swings up or down. Even the watching headlines is giving me headache because it's whatever number of percent down, then instantly whatever number of percent back up, and so on and so forth. So it's very difficult to remain and maintain your sanity in this environment. So what do you think about this volatility levels? Are they here to stay? What do you think will happen to it?
So I think what you're going to see is typical from like a volatility shock like we just had, which is aftershocks that'll be not as peaky as the initial shock was, but elevated volatility for some period of time. And it's really our expectation that you have probably a decade ahead of us here with generally increased volatility, certainly over what it was in the teens when you had single digit vol for some periods of time. I think you'll see normal to elevated volatility, and what we would expect also is probably less performance as well, and with equity market, moves. I think in the immediate future, the liquidity does play a big part, and stocks will continue to be powered by that. There's a lot of money flowing into the equity markets. One of the interesting statistics I just saw recently was that the poverty rate actually decreased over the last few months. There are people making more money now, unemployed, and a big proportion of the population than they were making employed. And that money's flowing into consumer discretionary as well as staples to help support some of the decline that you would have otherwise had. And people that had the means to get by without the money are using that money now to invest in financial assets. So I think you're going to see a pop in the market, but over the next decade, and I think I did have one slide that was showing this, a number of the predictions I think are fairly accurate as far as subdued equity market returns over the next decade, but with enhanced volatility. So you're going to be taking on more risk for less return.
Interesting. So the liquidity, the ultimate goal of not letting the market go down, basically driven by the Fed action. So you think that will still reach certain saturation point, or they will not be able to buy anymore because they will buy everything at some point? Or what would be the cause of diminishing returns?
Well, I think we're seeing a similar situation that we saw in 1999. You had the Asian contagion, In 98, stocks sold off quickly. Obviously, this was more severe and from a whole different cause. But then when it recovered, and you had a lot of liquidity put in the system then as well, but now it's just extraordinary, the amount of liquidity being thrown in at the system. People just become emboldened, with the market rising, and you start getting that invincible feeling. And I feel like we have a extended period here, next 6 months to a year, where valuations won't matter at all. Markets will just continue to rise because they did rise, and people will just be that much more emboldened. So I think what will happen is you'll hit the same kind of peak at some point where everybody's standing around looking at each other, and there's no greater sucker, available.
So you're breaking up. Is it my system or your hello, Mike? Looks like
I can hear you, Dmitri.
Okay, so it looks like Mike, please check your internet or something. You're breaking up. So, so speaking of that, again, currently review and sources. Let's take a look at the sources of market volatility as well, and see. So where is it coming from? So any comments on that? Because there is, of course, opposing different. Not opposing necessarily, but there are different sources, right? Institutions have their guidelines. Retail investors, probably going back to what Mike just has said about being emboldened and having some maybe even extra free cash that was given by the government as a support measure. So there is at the same time algorithmic trading that seems to be more and more bold-faced and I mean, emboldened also in their actions and taking larger and larger amount of trades and faster reading of news and reacting to things, and sometimes expectedly, sometimes not. So any comments on the sources of volatility? What exactly is driving this in your opinion? So Robert, I'll start with you then.
Yeah, Dmitri, I didn't hear the question.
The sources of market volatility. So what exactly is driving it? Or it's a combination, of course, but in your opinion, what are the primary drivers behind the market volatility?
As a money manager per se, I'm not interested where volatility comes from. I'm more concerned with harnessing volatility to advantage. And in this regard, when you have high volatile markets, you have disparate returns for various stocks. You have stocks that go up more than they should, and you have stocks that go down more than they should. We use it to advantage. When the market goes up, we tend to go up more, sometimes much more. And surprisingly, with the strategy that we're using now, we're going down less in down markets, which is a rarity among growth funds.
Okay, Jay, your comments on sources. If you also, do you try to see where the volatility is coming from, or do you just try to work with it as it goes?
Well, I mostly just try to work with it, but I do have complaints about volatility, and I think, you know, obviously some of it looks to just be fear-based, and we're still in that period where fear, people are afraid yesterday, and then the big day a week or so ago, you know, it just feeds on itself, and no one wants to be the last person out. So fear, and then number two, I think that's, you know, some of the volatility is going to come from risk parity, volatility targeting CTAs with their algorithms that are frequently trying to reduce positions based upon promises of keeping a sort of a constant standard deviation of their portfolio. But you know, who knows where it's coming from, how much of it's due to whatever, but certainly I think those are two likely areas. And it's not so much that I mind volatility targeting or risk parity. I mean, and who am I to mind anyways? It's other people doing what they want to do. And I'm fine with that because I don't do it, and I like it when people do things that I don't do. But it's the indiscriminate selling that kicks off sometimes, where hey, we made this promise, vol is picking up, I need to sell 5,000 S&Ps or whatever, and let's get it done very quickly. And I think that has historically created, problems. I don't like my stops to be hit at the low and then the market rallies. It's kind of a bummer.
So, and I think that goes to lots of the uniqueness about this environment, because as Robert correctly mentioned, it was one of the quickest, or is the quickest bear market in history, but it was also followed by the quickest recovery in history, if I'm not mistaken. So if you slept for a couple of weeks during the lockdown and just woke up, you wouldn't even notice anything, because like it just like a thunderstorm, it passed faster than it started. So Mike, can you tell us, are you back? Can you hear me? You on mute.
Okay. I'm back. I'm
okay.
back in.
So
Joe and I lost connection. I don't know what happened. So I thought it's because I was talking too long and you gave me the hook.
Yes, no,
okay.
I didn't. I wouldn't do that. So let's see. So we are talking about sources of market volatility. If you have any comments, or do you care where it's coming from? Do you just deal with the volatility as fact, or do you try to see who is driving it? Is it the retail investors, the institutions, the algo traders? Is there a difference?
Right. From our standpoint, we have a product we launched this year that is an equity hedge product. So it's long S&P, it's got hedge against that, and then it uses our futures trading we've been doing the last 40 years to help pay for that hedge. And we don't really care where the source of the volatility is. We just want to be able to mute it as much as we possibly can with the protection we have on the portfolio and the overlay we have with our futures trading. So it's not that important to us, I guess, one way or another. We don't make a change in how we trade our portfolio based on the source of the volatility.
So how does that make your program different? Can you tell us more than a little bit about how the Brandywine manages the portfolio?
Sure. Okay. So the idea with this, it's Brandywine Protected 500, and we can do it with any number of indexes. It could be the NASDAQ or the Nikkei or the FTSE, for example. And what we're doing is gaining long exposure to that index, usually through a very passive approach, and then buying put protection on that. And that's generally running at a cost of 5% or maybe even 6% a year, depending on the volatility of the market, where it's at, and how we structure that protection. But then we layer in our futures trading as an overlay, and that's paying for that put protection over time. And the performance you're showing there that's just the S&P with a naive put protection on it, buying at the money puts, for example, hold them for a year. And then Brandywine's trading for the last 40 years layered in on top of that, saying, okay, if we had done what we'd been doing with our futures trading and added that as an overlay to the program, here's how it would perform. And what's great about it is that the put protection itself totally mutes the downside exposure from the equity trading. So when you have a period like we just had, where we here, and that you're showing the 2000s there, those two big bear markets where you had 50% drawdowns are truncated to upper teens. You still have 100% long equity exposure, but it's the put protection that pays off through that period. So instead of the 2000s, for example, being a negative 1% annualized return, you end up with a strong positive return through that decade, because now you're recovering from a higher base. When the market recovers from a 50% drawdown, you need the 100% return. Obviously, if you get that same 100% return recovering from a 20% drawdown, you're already up 60, 70%. And so that's the whole concept of the product, is we don't really care about the source of the drawdown, the source of volatility. Let's just protect against it so that when we're recovering, we recover from a much higher drawdown. And then let's help pay for the cost of that protection with the diversified alpha, the futures trading that we've been doing for the last 40 years.
And I think this is one aspect of volatility that many investors, especially novice investors, do not recognize thoroughly, is the asymmetry of compounded returns. Because if you drop 50%, you don't make it up with 50% move up. You need 100% back up because your base is now half as small, basically. And this relatively simple math escapes many investors, I think. So that's where volatility gets you over time, because you get up 10, down 10, up 10, down 10, and it seems like you're supposed to be neutral, but you're actually out of a few percent of your portfolio already.
Definitely.
And so, and if it moves this fast and this quickly, and it changes direction so much, then obviously something needs to be done with the volatility. So Nikolas, what's your view on volatility? Again, as far as the sources of it, do you handle specifically? Do you try to see who is doing what, or do you just handle the market overall?
It's not an input to our process. We don't sit around trying to deduce where it is. It sort of seems a little bit like mental masturbation to me. If you spend too much time thinking about this, if it doesn't have a way to go into your process. But having said that, you know, I do think about these things, but the way that I approach it is to basically spend more time at the strategy level than at the market level. So what I'm trying to do is I'm trying to develop alpha sources which basically fill a particular portfolio need. So when we're developing alpha strategies, we basically take for granted that, like markets are cyclical, alpha is cyclical. And so what we're trying to do is basically simulate the behavior of thousands of professional investors that follow some specific trading strategy that we can define. We then extract a best-in-breed index for each one of those well-defined trading strategies, and then we basically use those to slot into the different mandates of the programs or funds that we're managing. So we call this approach a swarm intelligence approach, because essentially what we're trying to do is swarm source alpha from simulated managers. And most of the processes that are out there, you can turn into some systematic index, which is transparent, and that's basically our approach. So in terms of, you know, what we're doing to deal with volatility, I guess I'd sort of say it's a several pronged approach. We do you know, extensively rely on risk targeting. We do believe quite heavily in risk parity, but we probably implement it quite a bit differently than other implementations that you might have seen out there. But fundamentally, we are more interested in the realized volatility of the alpha strategies that we're choosing to employ in a portfolio than we are in the underlying market. And so there's an embedded value that we're trying to take the sort of higher volatility underlying market, or you know, whatever the volatility environment is, and then be able to normalize it before it comes into our portfolio and causes negative damage. So the way that we approach that is basically we have time diversification, so we're trading at different periodicities. And again, this I guess, going back to the sources of volatility, I think when you have a volatility event where you have a market, you know, cascading down in a fairly short period of time, not that this matters, but this is sort of a retrospective explanation for it. I would argue that what's going on there is that in ordinary circumstances, you have different traders with different sort of structural preferences for when they're going to trade or how frequently they're going to trade. When you have some sort of global event, you can run into a situation where everyone's or a lot of the traders' periodicities go and shift towards being short term, and some of the people that would ordinarily be there providing liquidity have backed out and aren't there anymore. So a longer term trader or a longer term manager is just basically not going to come into play because they're not going to be in the market, because they think, you know, we are a lower frequency trader. So we'll wait until this move corrects. And I think in situations like that, if you have this sort of single-minded view where you are this kind of trader, I think that can actually lead to more volatility. If you have some flexibility, or if there were more people with flexibility in terms of where they thought they would trade, I think you might have a market which was more muted. But I don't know if that's something, from a policy point of view, I don't know if we want a market that's more muted. We probably want the information to come out in, as efficient a manner as it can. I think that's mostly what I would say to that point. Just one more. So I guess the other thing that comes up when we're talking about our approach is that we tend to be sort of strategy agnostic. We want to be tracking different strategy styles. We have a core style in our strategy, but basically we're tracking other styles, and they do play a role in the portfolio. And again, I'm talking just from the highest level in terms of mean reversion. I think of as a sort of short volatility play, and under some circumstances, a mean reversion style strategy can have a weakness where if you have runaway markets, it's not terribly shocking to have a mean reversion strategy underperform. But the remedy to that is to have some long volatility portion of the portfolio there to kick in. The sort of third leg, which I think can do a lot of good in a number of different environments. And again, it's sort of close to what Mike was talking about there, is having some cheap put in the portfolio. So the way that we approach that is we sort of have a dedicated corner of the portfolio where we include assets which I would classify as either anti-fragile or assets which are going to tend to appreciate during times of turbulence. So in that corner of the portfolio, and again, that might include things like gold or interest rates or oil or different sectors of the S&P, if we're talking about the equity market, and the VIX. So essentially what we're doing there is, instead of trading single product markets, we're synthetically creating our own indexes, which are basically purpose-built to experience convexity during times of turbulence, and we're building alpha off of those bespoke indexes. So that's the way that we approach it, and I think it's pretty unique, and it basically fits the bill in terms of trying to get some inexpensive put in the portfolio.
Okay, well, thank you so much. So I think that brings us to the actual techniques, if you can share that, to a degree that you can share that. So how exactly do you manage this extraordinary volatility in your portfolios? And Chesapeake Jerry, please, would you mind commenting? What do you do? I know that you like smaller trades, a larger number of smaller trades, kind of trying to do many things at once. How do you handle that?
Well, I mean, I think I try to come in every day with a very safe portfolio. I kind of want to be prepared every day for this crisis and this crash as best I can, as best as a more of a medium to long-term trader is. So I want to have some stocks, stocks and some currencies and commodities and interest rates. I think almost as important as that is some shorts. I think that having the stock shorts is a big deal. It's I don't want to rely upon my quickness and my systematic approach, my rules. I want to be more prepared than that, and hopefully I'll not suffer as much as I normally would. But I think coming in with a very diversified group of equities that hopefully don't look too much like the S&P. I mean, they are going to all go to one, in a period like we had. but I need to be short. And so fine, if I've got some shorts on, they go down, you know, they probably won't make as much money as I'm losing in the longs, but that's what I'm trying to do every day, is assume that I need to be afraid and I might have a crash, and I might not have enough time. It may happen overnight or something. And then, as I said earlier, being pretty dedicated to a systematic rules approach doesn't mean that, to use a technical term, when all hell breaks loose, I won't try to reduce my risk and just ask questions later and then wait for things to kind of settle down and start the process of going back to religiously following my rules and putting the right trades back on in the quantities that I'd like to have them on when things kind of get back to normal. And as you said, it does look like we trade a lot of different markets, a lot of different stocks, longs and shorts. We're making smallish decisions all the time. So we're not putting ourselves in a situation where it's make or break with this decision. I think the biggest mistake that I've made over the years, and probably the most important thing to think about for traders or investors, is I've traded too large. And so from my personality, I will say that I need to get in line with my risk tolerance and make sure that I can sleep at night and have fun in life and not check the quotes all throughout the night, and getting that risk budget and the risk levels where you need them so you can execute your system and not continuously try to override it is very important.
I can attest to that, because in my experience, and I'm sorry I forgot to introduce myself, I focused all on the panelists, so I'll do that in the end. But in my experience as a CIO and head of research for a hedge fund, fund of funds, and index provider, I have seen and interviewed hundreds of managers, and you can definitely tell who can sleep well at night. It's an important characteristic of trade strategy. I support that, because there are some people who are comfortable not doing that and who are comfortable checking quotes in the middle of the night. I also know some great managers who have computers on both sides of their bed, so that whatever side they are sleeping on, they can open one eye and see what the market is doing. But personally, for me, that wouldn't be a lifestyle I would wish. But at the same time, some people are good doing that. So with Mike Dever, with Brandywine, so I know you have some views as well, and also how do you handle volatility? And I know you want, you have sent us some interesting slides. So would you like to comment that?
Sure.
And sorry, your picture seems to be flipping from 90 degrees to normal somehow. I'm not sure.
How is it?
Now
How's it now?
Now it's your desk. You flip the camera. Now it's the pencils. Can you?
See if that,
yeah, now it's you, but 90. Okay, I think it's fine. We can visualize. So let me play this chart, and because it's an interesting chart. Go ahead.
Yeah, what we're talking about on this is really taking it. This chart's talking about taking advantage of market volatility, and this is a strategy we developed it about a decade ago. That's looking at equity flows in and out of the aggressive equity ETFs. And I wrote a book in 2011. I published this in the book for people to look at. And the performance you see there, that first part, was the performance of that prior to the publishing of the book. And then I updated it recently through this latest crash, and you'll see this huge spike in performance at the crash. And if you go on to the next part of it, you'll see what happened here, which is when the financial, not the financial crisis, but when the market started melting down here from COVID, the investors just came in initially in that very bullish, and the strategy is looking to fade investor behavior. So it's looking at sentiment and being super positive as a reason to be short, go opposite the general investor sentiment. And that did really well, took advantage of the initial part of the decline, or the most part of the decline. And then the sentiment set in was really, really negative at that trough. And this strategy, again, is looking at money flows. So it's looking at not just people saying how they think about the market, but what they're actually doing with their money. And they put a lot of money into these inverse 3x inverse stock funds, and took a lot of money out of the leveraged long equity funds. So they were betting with their money that the market was going to continue to fall. At the same time, you could also see surveys such as the AAAI survey, American Association of Individual Investors, which was at one of its highest levels in 7-8 years for bearishness. That coincided almost exactly with that market bottom. Since then, the market's rallied 40%. So one of the things we're doing is not just trying to cope with volatility by having put protection on our equity product, for example, which is it's a protected equity product, and our managed futures products having broad diversification and adjusting position sizes. And Jerry alluded to this earlier, having a process to say, okay, we've got a lot of big moves here now. Instead of making 1 or 2% moves a day in volatility, it's jumping 5. You want to make sure you adjust your position sizes to account for that. But in addition to doing that, you can also profit from that volatility. And this is one of those strategies that was able to do that.
Well, this is great, and it reminds me of the probably one of the oldest well-documented leading indicator of a bear market. Goes back to Mark Twain, right? If I quote him correctly, if you start getting stock buying advice from a shoe-shining boy, then it is time to sell. So it seems like with the retail craziness, and I keep thinking about people massively buying a bankrupt herds, things like this, it can tell you a thing or two about the sentiment in the market. So and probably it echoes with the sources of volatility, but more like sources of the money and where the money comes from, and then where the money will go next. So,
right.
So let's see. Nikolas, do you have a comment on that?
I'd say broadly speaking, ways to deal with it. Different types of diversification, both cross-asset and time diversification. I agree fully with having a process which can respect and reflect the realized volatility and adjust position sizes to basically give a smoother ride. And again, I think as well, having some sort of strategy diversification as well. And then that last leg is, the degree to which you employ, an anti-fragility or crisis alpha leg in your portfolio. I mean, if you're willing to have that there, it might be a drag in good times, but probably in the long run you'll be happy to have it. And if you can spend time trying to make sure that put is as cheap as possible, I think you're giving yourself a good chance.
And let's see, Robert, what's your comment? So how is manager like you, to rephrase this, handles the volatility? So we did discuss that you don't care about the sources, but you still deal with it as a whole. So what do you do?
We do what we always do, the same thing. We're not concerned about volatility, as I had mentioned. When you have increased volatility in the stock market, you're going to have disparate returns for various stocks. Some stocks go way up and some stocks go way down. They don't go to such extremes in a less volatile environment, but basically we have a quantitative system that we adhere to irrespective of whether the market is going up or down, irrespective of whether the market is less volatile or whether the market is more volatile. We are very, very steady in the application of our investment disciplines, regardless of the volatility of the market.
So regarding the techniques, are you in favor of concentrated portfolios or because there's different opinions?
I had mentioned earlier in the intro that my portfolios have always been characterized by high portfolio turnover. And in those days, which was most of my career, I would be aptly labeled as a trader because there was a lot of in and out. Because of the prospect of taxes being levied on all securities trades in the future, which is almost a certainty given the gargantuan federal deficits, we had to come up with investment disciplines using low turnover, but in the same investment style. And we've done this. Normally, my portfolio turnover has been very high, as said, in the area of 800 to 1,000, 1,200% a year. In the first 6 months of this year, in 25 stock holdings, we've only had 11 switches. So we've done this in a less volatile environment. And what we do has been rewarded in the stock market because we are very positive on the year, whereas the broad-based indices are somewhat down.
And for types of instruments, do you favor anything in particular?
Well, we're agnostic. I think Mike mentioned the word before. We not only concentrate assets in a 25 stock portfolio, but the portfolio is very concentrated in 3 sectors: internet software, technical software, and biotech.
Very interesting. Thank you so much. Nikolas, what's your technique of managing, well, the management strategy in general, and specifically as it applies to the current times?
Am I jumping ahead of anyone? Has anyone else not spoken? I think I might have addressed this one already. So.
I think, well, we're trying to look at the different angle. I think we've gone a full round already. So now we're trying to see, and those are echoing subjects, right? The sources of volatility, as we discussed already, and how individual managers deal with that. I think we covered everybody. Do you have another comment that you want to add?
Not in particular on this.
Okay, so what we can do then is focus then maybe on some perspective that can be useful for investors who are attending today and listening to this interesting conversation. What would be the suggestions? So then from the point of view of investor, what is it that we can recommend as professionals in the field, if anything? Obviously, this is just a webinar. This is not an investment advice, but we still want to share some opinions. So I think it's perfectly understood. And please go ahead. Do we have Mike? Are you having connection? Is it working for you? Mike Dever? I think we lost him again, so let's try to, let me see. So as far as Nikolas, then let's go ahead. Do you have advice for investors?
I find it very difficult to think outside of the realm where I'm working. So I think the first thing I would say is, find a professional that you can rely upon, and make sure that you either have access to a vehicle or you have enough capital to trade in a way that is sufficiently diversified. I think a lot of mistakes can be made by, either getting too concentrated and not being able to control risk if you are an individual investor, or perhaps investing in too many of the same things. So, I mean, that's one of the angles that we've taken, is that we're trying to create something that's quite unique through this swarm intelligence technique, and the concept of building an arsenal of strategies which are transparent and systematic, and then basically being able to pull them off the shelf and use them in a portfolio to create lower risk, asymmetric type returns in a variety of different markets. So, I mean, I think that's the most important thing, is to find a way to diversify your sources of alpha. And I think we've actually found a way to do that within a single vehicle. So that's why I think our approach is potentially attractive to investors, because much like a fund of funds, we're essentially internalizing the process of manager search and investment and due diligence, because we are going through this process of simulating the performance of thousands of managers, creating best in breed indexes to represent them, and then basically rebalancing between these manager styles, which are currently in the ascendancy, but without the frictions that you would expect if you actually went out and tried to invest in 3 or 4 or 5 CTAs.
Thank you. And we have Mike back, so I'll ask him this question. So echoing what Robert mentioned is that there's potential of changing legislation, changing market microstructure, and extra fees and things like that. Is buy and hold then back to be, or has it ever been always a valuable strategy? What's your view on buy and hold, or variations of it?
So our approach, our belief is that there's always better ways to buy and hold than just buy and hold. And especially, I believe, with the types of forecasts and expectations we have going forward with high valuations today, that over the next decade, we probably do expect to see a fairly significant drop in overall performance of buying and holding equities. So we've never been a big proponent of it, because for us, it's a bet, kind of a gamble on a single return driver, which is ongoing corporate growth. And I've had plenty of people I've had this argument with who believe strongly that the U.S. is exceptional and that growth will continue, and stocks will continue to go up because of that. I've never been comfortable making that single bet. I do think there are periods that could be extended where stocks don't perform or corporate earnings growth does not occur. And I guess I just don't have the hubris to assume that I know that it will continue. So our belief is always prepare for the worst in a way. Expectations that the past might not be precursor of the future. There might be something that's different performance-wise, and you need to be prepared for that. So we've always been broadly diversified, long, short markets, globally diversified, and a lot of markets, as well as across a variety of different strategies. Like the one we showed earlier for, trading equities. That's just one of dozens of different strategies we employ in our portfolios.
So there's nothing wrong with a passive strategy as long as you know when to be passive and when not to.
Yeah, exactly. I mean, right. So to me, it is a strategy. Buying and holding equities is a strategy. And why would you bet your entire portfolio, your retirement, whatever it might be, your legacy, or an endowment, or whatever it might be, on that one strategy? Sure, as good as it is, and maybe it's got a 95% probability that it'll continue in the future like it has in the past, why would you still put all your money in that one basket when you have other opportunities to diversify your portfolio and end up with just what modern portfolio theory states is better returns at reduced risk, especially if you can reduce drawdowns. I mean, reducing drawdowns doesn't reduce returns, it increases returns. And this is something a lot of people just assume, that if you're reducing risk, well, it's coming at a cost and returns are going to be reduced. But actually reducing the drawdowns is what increases returns over time.
Dmitri, can I go back to the advice to managers item on the agenda?
Of course, I was just trying to find, I think Mike had a chart.
The question that's posed in the outline is advice for new investment managers.
Yes,
Yeah,
definitely.
I spent 10 years, in my first 10 years in the business as an analyst. And I think first and foremost, in order to become a good money manager, you have to become a good analyst, because the two functions are inseparable. And for a new aspirant trying to become a trader, I would suggest you have to do tons of research and spending many hours, even years, developing a process that works. Now, that's the first step. The second step is that we all go through bear markets, and they're very painful. And when you go through a bear market or you buy a stock that's going down, you tend to question yourself, what you're doing, does it make sense? Have you lost it? And things like that. When the market's going down and the world is falling down around you, if your investment process is sound, you stick with it. And in bad markets, it's more important to have a strong stomach than a strong mind and just see it through. It's very difficult for most people because when there's pressure around you, in my early years as an analyst, we went through 2 bear markets. And I was always at the end of the food chain. The guy running the division would start yelling at the portfolio managers. The portfolio managers would take it out on the analysts. There was always panic in these years that led to unwise investment decisions, leading to the 2 firms that I worked for being out of the stock market in the early stage of a market recovery, which is very powerful. The stock market tends to go up most. It goes up very dramatically in the first 3 months off the bottom, typically 25% or more. But those experiences were very telling. Become a good analyst, develop a good discipline, and stick to it no matter what.
So you're saying that you can't just buy a stock and get rich quickly and just enjoy your life ever since, right?
Well, there's an interesting study on portfolio turnover done by A.G. Becker, who was the first pension consultant. And the view evolved over the years that managers who trade are costing too much in trading costs, and if they traded less, they would make more money. Well, it's not necessarily true, because in the Becker study, they found that managers with the highest turnover were the best managers. And it can be done, it can be summed up very simply. If you know what you're doing, you do it. If you don't know what you're doing, you don't do it.
I think that's a great way to put it. So let me see, let's say, Jerry, what is your advice for investors or aspiring money managers? I think often it's one and the same. If you trade your own money, but well, obviously some differences.
Yes, well, as I said, I think diversification is key. I agree with what Mike said about the S&P. I won't repeat all of that. I do think that this, from my point of view, which I'm not shy about a controversial point of view, but I would say that a small allocation to the S&P long only is fine, and fill it out. The other 80% would be probably something with a better return risk. I think to make 8 or 9% over time with a 50+% drawdown doesn't sound that great to me. But I think, like I said, diversification, trade your 15 or 25 stocks. I don't like to trade the indexes. I want to put in my portfolio 15 or 20 different types of stocks. Don't be afraid to pick some weird stocks that don't look like the S&P. And don't pay too much attention to historical performance. They can surprise you in the future. Be prepared, have some shorts on all the time. Hopefully, it's difficult now, but most of my shorts have rallied a lot. But still, I think that would be one of the goals. Pay attention to price, pay attention to trend, reduce your positions when you're getting killed. And I think it's perfectly normal to talk about risk control and diversification and taking small losses and having stop losses and things like that now. But over my career, I would say that where I've blown it the most and where I've made the biggest mistakes is sort of short-circuiting my profits. And so if you get a hold of a big one and it's doing really well for you, don't be eager to get out. It can pay for a lot of your stocks that didn't make money or the losses that you had. So I think that's the biggest mistake I've made, is taking small profits. Try to let those profits turn into really big ones.
Great. Nikolas, did I already give you a chance to comment on suggestions for investors or aspiring money managers?
Yeah, no, I think I'm comfortable with what I've said already.
Okay, excellent. So I think that covers our most of the agenda items, and we have some excellent questions in the Q&A section. So I think it's worth to actually commenting on that. If you don't mind, we still have time, and some of these questions are pretty good. So I'll just go by the list. And again, if you don't see it, it should be somewhere in your Zoom controls as far as the Q&A. And there's open questions and answered questions. So some of them, let me try to voice them out and see if anybody else wants to comment. So for example, how long can the disconnect between fundamentals and earnings last? And Nikolas answered to that. Any other comments?
Yeah, I think it can last a while. You know, again, I use the analogy of 1999, where you had NASDAQ running up, essentially doubling over the course of that year. Earnings were moving, but nowhere near at that pace. So I think you can have a year or two of disconnect from the current level we're at, but at some point there comes a reckoning.
Okay. Another interesting question is how many panelists have invested in machine-assisted investing as a way to deal with the current market environment? And that probably can be phrased also as a machine learning technique. Robert made an excellent comment historically that originally there were almost no machines, then there were some machines that were helping with something. Now it seems the tables are turning, and now people are quite often playing the role of assisting the machines and whatever the machine doesn't handle yet. So what are panelists' view on machine learning, especially in such a difficult environment? Because it seems like since it's unprecedented, then okay, how do you make the machine learn? What is it supposed to learn from if there's no environment like this to learn from historically?
Well, what we are doing now would not be possible 10 years ago, because the amount of data has increased by millions fold, and the sophistication in crunching data has increased to a level that's probably in the stratosphere, and it has made my job a lot easier to run a fund. I'm not making as many decisions as I did in the past. I measure the decisions, and the decisions for the most part are very good when we make changes in the portfolio, and it's all predicated on the quantitative tools that we've created and put into use.
So thank you. Another good question is if you changed or had to change or don't change at all the rebalancing frequency or techniques, and what is the view on dollar cost averaging? So has anybody had to change their behavior, rebalancing frequency, sizes?
We never rebalance in our fund, only at year end. If a stock is running, and if a stock's going to en route to a triple-digit return, you don't know. You don't know which stocks in the portfolio are going to work, and you don't know which stocks in the portfolio will work. And for that reason, we start out each year by rebalancing the portfolio once and let the stocks run. The stocks that are moving ahead typically are regarded as being overvalued, but what typically happens in the current market environment, overvalued stocks become more overvalued, and we don't want to use a subjective opinion by rebalancing. We just let the portfolio do its thing, and then at the end of the year we restart the clock.
Okay. Anybody else? Any changes to rebalancing techniques? Unless we have covered your approach already. So the discipline seems to be quite strong with all the panelists. They don't seem to be freaking out, so to speak, if I can use a term like that, even despite this difficult environment. And I think that is something also that has to be learned, right? You cannot be way too emotional in such an environment and have to maintain calm head as much as possible. So let me see another interesting question. We did mention machine learning. Let me see, and then there's some open questions as well. So let me see what can be interesting. Okay, so links, we can follow up on that. So just learning, there's so much information. There's one question, can we provide links for retail investors to do further research on their products? So one of the things is obviously these are regulated products like hedge fund products, so it's not always suitable for retail investors. But at the same time, there's so much information on hedge funds and hedging out there. All you have to do is Google. And I don't really think there has to be any additional info, but if anybody wants to share some links or things they like, or maybe even books, then please let me know and I can respond, or you can respond to the question directly. So also, what is your view of cryptocurrencies as an uncorrelated asset and store of value versus gold? And let me start with my personal comment. It seems very strange is that just a couple short years ago with the crypto boom, right? It was almost the same story with retail crypto investors, where it was primarily a younger generation who hasn't experienced a drawdown before, and they thought that cryptos can only go up. Now this mentality seems to have settled, even though on a much shorter scale, with the retail stock trading. Again, there is a lot of younger people who are putting money into the stock markets, and they just keep going up last few months. It seems like that's an unstoppable and easy process to make money. So I had $100, now I have $200, and I'm rich. And so it seems like the levels of volatility in equities are now approaching some of the crypto volatility, even though that was way off the chart. So any views of gold, cryptos, stocks relative to each other from any of the panelists?
I think probably it's not a particularly great store of value yet. Maybe it will be at some point in time. I think there's some argument to be made that it might be like digital gold, and there's some argument to be made that if you were asked the question, how could I create a portfolio to benefit from the decay of monetary policy and the rise of international money laundering, you would probably include a cryptocurrency exposure. So we've spent quite a bit of time building some one-off crypto futures programs. We're going to be launching one fairly shortly. In terms of my view of it, I think it's an odd duck because it's quite difficult to get realized volatility in the strategy much below 60% annualized. Okay, so it's a very, very lively thing, and that's even with fairly modest drawdowns. I think the drawdown on the program somewhere in the neighborhood of 15 to 20% annualized, which is dramatically less than a passive exposure in a cryptocurrency. I think the issues more have to do with sort of counterparty risk. Where do you go spot crypto versus the futures? Do you want to open up an account where you actually have to transfer funds into a cryptocurrency, or are you happy just getting exposure to it through futures or through a CFD? I think those are the bigger issues. But I think just like anything else, probably it makes some sense to have some small allocation to it, because I'm a big sort of fan of the Austrian School of Economics, and basically this concept of multiple currencies is a prediction of von Mises from 160 years ago. He basically said that this is the type of thing that will eventually go on, that governments won't have a monopoly on the creation of money. And if you know, that is something that takes hold, then, you know, why not have some skin in the game so that you can understand what the hell is even going on in that asset. I certainly wouldn't advocate it as, you know, sport or something that you should do without putting a lot of thought into it, but probably it plays some role going forward in asset allocation. But I think you have to have it in a you know, an active management environment, just because of the sheer volatility of the thing and the fact that, I mean, like a lot of currencies, it's not, I don't think you can go into it thinking of it that it's a store of value.
I agree. I like Bitcoin. I trade the Bitcoin futures. I like it because it's liquid enough and it's different. It's kind of funny that I might have cocktail party opinions on currencies and stocks and commodities, but given I have no idea what's driving Bitcoin, and I'm never tempted to think about it in any other terms other than what does my trend system tell me to do. I don't like any asset at all that's standalone, permanent fixture, long only. I can count on it, gold either. So if a Bitcoin is going up, I'll buy it if it's in an uptrend. If it's in a downtrend, I'll go short. I kind of throw it into the currency sector, and I trade 20 other currencies. So it's smallish. I'm not even thinking about it. I do like it. I bet a lot of my clients probably wouldn't like it as much because it is a little, I think, scary and to some people. But it'll probably be a big thing one of these days. But I don't care about it in any other way that it does maybe offer a slight improvement to my overall portfolio.
We actually had a small Bitcoin mining operation a few years back here. I consider it the most speculative, purely speculative market that exists, because it's really based entirely on perception. And there's really no basis in other real physical use of it, like there is with gold, for example. So it's from a trading standpoint, it's great. It sets up nice trends. On the long term, because of the limited supply, all you need is a small uptick in enthusiasm for owning it, and you can get some big multiples in performance as far as and price multiple. So it's a great trading market, but it's just purely speculative market. There's really no basis in it that you know, I could look at like the other markets that we trade in.
From my personal comment, it also seems that cryptocurrencies, or the large ones in particular, are kind of very sensitive to political environments, especially when the talks about the discussion turns into regulation, restriction of asset flows, because quite often the cryptocurrencies are being used to transfer assets between jurisdictions and things like this, even though that goes beyond the idea or the structure of perfectly clean and legal investment. There's many open questions about that kind of activity, but I did notice some moves when people were trying to move money out of China or Hong Kong for recent events and things like that. But that is an entirely different dimension, and it probably also adds to the diversification some sort, because it creates sensitivity to factors that may not be necessarily reflected in the regular types of assets. So that's also something to keep in mind that can change due to regulation quite a lot. Well, I think let's ask a little bit one more question on clean data. Obviously, there's lots of data to research. Discretionary traders have their own sources and their own views. Systematic traders obviously need to train the machine to do the work. So how do you get it, and are you confident that you have quote unquote clean data? Any comments on that? No comment? So, well, then let me throw my research piece, not piece, but my research view as well.
Dmitri, would you repeat the question, please?
So how confident you are that you have clean data, and how do you get it?
Okay, I have an interesting story on that. we started off with 2 funds a few years ago, and we were working off 2 models, and 2 years went by where the model, the real portfolios were not tracking the models. What we ultimately discovered is that we had ended up with a bad data bank. And the reason it was bad, we built our models going back 15 years. And in the early part of the 15-year period, companies that were acquired or merged had their symbols up for grabs and were assumed by other new companies coming public. So the companies that we thought we were analyzing were not the actual companies that we were focusing on. It took us the better part of a year to fix our investment process, and we got it back to where it should be, but we lost a lot of time in the process. And the data bank that we were relying on is a very notable and reliable name that I will not mention.
Yep, and I remember issues like this when you analyze the data, specifically when tickers change and corporate action happens. And if you are not aware of that, then exactly right, what happens is that you're looking at the wrong data. There is also a double-edged sword kind of effect to clean data, I think, as I have talked to many systematic traders, is that in real life, there's always a chance that you experience glitches. So there's an incorrect data feed, there is an error in reporting, there is something else going on, a false headline that gets quickly reversed or something like this. So if you are not capable of dealing with real life glitches, so to speak, and only train your system on clean data, you are setting up yourself for a risk event, which can be caused by such an event, such as an erroneous headline or incorrect price feed or something like that. So I think that is important to also keep in mind. And the clean data is like distilled water. It can help and it can hurt. So it depends on what exactly you use it for. So any other comments from participants? I think we touched upon the questions and answers and covered the topics. I think it was a great discussion. Any last comments from participants? Oh, okay. Well, I think with this, we're perfectly on time, and I thank everybody for joining and putting their time into this interesting webinar. It has been recorded, so we will put it on our blog. And I'll just quickly introduce myself and the project that I'm running, because again, I forgot to do that at the beginning, focusing on the panelists. The project that you see on the screen is called AlphaBot. You can find more information on alphabot.net website. And what it is, it's basically a professional network for alternative investment research. We have a blog post, blog section where you can find a lot of interesting observations, posts made using the system analysis, and as well as find the webinars, both the schedule for upcoming ones and the recorded ones. And what you can also do is you can open an account and you can also use our web interface or download the system that I use here, because the full featured version is downloadable program for Windows, but we also have a lot of functionality already implemented on the web. It allows you to communicate with managers just like today on the panel, and they will have their accounts as well there. You can subscribe to data feeds and databases on cryptocurrencies, hedge funds, ETFs. You can build portfolios in literally a few clicks and save yourself a lot of headache from learning Excel formulas and things like this. And most importantly, you can communicate the results, the observations, the reports back with your clients, back with your investors. So this is really a professional network. In some sense, I can say, let's say it's LinkedIn, where you can communicate with the parties, but what you can do also is you can request access to the presentations, to performance track records, and use those track records instantly to do analysis and portfolio construction and make investment decisions for alternatives specifically. But it is also supporting multiple asset classes and data frequencies, so that you're not stuck with only monthly data or only daily data and things like that. So it can work on multiple levels for multiple sources. I hope you enjoyed today's conversation. If you have any more questions, please let me know. Please follow up. And again, hope to see everybody soon again. We will keep running our webinars and looking for good topics. If you have any suggestions, please let me know.
Good, thank
Dmitri,
you.
I'd like to thank you as being our host and my fellow colleagues for a good discussion today.
Thank you so much, Robert.
Thank you, Dmitri.
Thank you, Jerry.
Thanks, everybody.
Thank
Right.
you,
Thank you,
Nikolas,
Mike. Bye now.
Mike. Thank you. Have a great day. Bye.